Alrighty, welcome everyone. Welcome to an introduction to Hurley Investments. And as you can see there on my screen, the Ultimate Portfolio Insurance Strategy. My name is Kevin Hurley by way of introduction. I'm the owner and managing partner of Hurley Investments. I have been asked by clientele and by the Registered Investment Advisor representatives that work with me to go over what our insurance strategy is that saves so many people so much money over 2008. And why what we're doing for our clientele helps people truly be able to retire at the level of income they want. As I go ahead here and bring up a couple different things, I've got a chart of the Dow back in 2014. The Dow is up roughly 7.5%. Literally, when I take a look at a chart like this and that upward movement, as you can see by that arrow, I get excited. I get excited when I see an index, no less, move from the 16,600 mark all the way up to the 17,800. That's a great movement in the year. In fact, that's a pretty historical average return for the market. Unfortunately, as I talk to potential new clients, as I actually talk to other people that are licensed in the industry, when I go to the Las Vegas Money Show, as I've talked to thousands of people, especially about 2014, I hear not about how great the year was, but literally I hear about the pullbacks. I hear about these red arrows where you see the index come down, and unfortunately, this is what has killed people. These pullbacks affect everyone with an emotion of fear. We go right back to that 2008. Oh my gosh, our market's going to crash. In fact, if you do some valuations and just look at the debt that the U.S. country is in, our future looks pretty bleak. We're all expecting another correction or pullback in the near future, and that correction and pullback based on our debt, the possible loss of a reserve currency status, of the opportunity that we still don't have the jobs or the income that we used to, the next correction in our stock market could make 2008 look like it was just child's play. So as you see these pullbacks as the market comes down, all your hedge fund managers, all your mutual fund managers, any fund manager is trying to sell out to book some profits. And unfortunately what happens is we sell out at those bottom of those arrows, it comes back and we miss out on the upward gain. And at least 4 times last year I heard of people that literally booked losses upwards to low to high double-digit teens when the stock market was up 7.5%. This is the reason why most of those mutual funds or the funds that you're in don't ever beat the S&P 500. I think the true metric is that 90-some-odd% don't beat the S&P 500. It's because those fund managers have the same emotion you do, have gotten you out, it goes back up, you're booking losses in those positions, and you're missing that upward movement. So what do you do? What do you do to combat that? At Hurley Investments, we use that long put contract. We're a big believer that you should insure your retirement. In fact, well, I'll hit on that here in a second, but what are we doing? We're buying that long put contract. You're buying insurance on your stock. This gives you the right to sell a stock at a certain price for a certain period of time, no matter what that stock price does. Literally, your stock price can fall 50%. We're going to have the right to sell it at a higher price. The neat thing about this long put contract is it goes up in value as your stock goes down. I just use that example. You could buy a $100 stock. It could drop $50 down to $50 a share. The good news is that long put is going to go up $50. You literally are buying insurance on your retirement. You'll notice that last little comment down there, I put long puts can be used in insurance policy for your stock ownership or your stock positions. Guys, I don't understand why. We insure our house, our home, our car, our health. Sometimes we insure our life. We do everything we can to ensure ourselves that we're going to make it out to retirement, but we forget to ensure the most important part of retirement, and that's the income stream we're going to have during those retirement years. Why don't we insure our retirement like we insure everything else we do in our life? How does this work in real life? I'd love to show you an example on Pandora. Pandora was supposed to be the next Apple. It was supposed to literally go from $30 all the way up to $75. In fact, if you took a look at when most analysts and most institutional traders were piling into this position, it had a huge upside bias. For our example, we only legged in with about 300 shares. It cost us $25 a share. Pretty smart position to be in, especially since it then went up to almost 30. But right here at that black arrow, we got ready for earnings. Now, whole world expected it to shoot up to some ridiculous numbers. I said, basically, $75 or higher. But in real life, if you look at that red arrow, everyone that thought they had it all figured out found out that Pandora could get all the way down to below $16 a share. If you had this position in a fund, you would be told by your investment advisor, hey, don't worry, it's going to come back. Even though maybe a Microsoft or a Cisco, and boy, I could name dozens of stocks, have never come back. Oh, don't worry, it's only down 30%, but I'll make it up in another trade. Something else that they're going to try to outguess on. Don't worry, you're down 30% here, but we're up 10% in another position. Guys, in real life, you're lucky if you get your money manager even that's going to answer your phone. I don't know how many times money managers disappear during this time period. Oh, I never got your message. Sorry, I didn't call you. The neat thing is we're usually calling you. We're usually calling you because when we got into Pandora at 25, ran up to 29, we didn't protect it up at 30 when it got to the highest point, but we protected it up at 29. We bought that insurance contract. What a world of difference that made, especially in this position. Thank goodness we did that, because those 3 insurance contracts that we purchased, completely paid for using a little different method I'll talk to you about later, but those insurance contracts ended up being worth $11.50 a share, or worth $3,450 total. In this particular position, we completely made up the loss. In fact, it was really fun to call and let some people know, hey, by the way, we're in a risk-free trade. We hope it goes up to 75, but if it does go down to 16, or in this case 17.50 where it's trading at when I took a screenshot, we've got you in a risk-free trade. Now, you'll notice in that last little comment, with $3,450, we would buy 200 new shares of stock. I love what Hurley Investments does. We dollar cost average your stock for you without ever having to come back and ask you for more money. Dollar cost averaging is a great method to lower cost basis in the stock market. It's proven. It's a true, trident, well-used position. But for a money manager to take a look on our side, or if you're doing this trade yourself and you're having to explain it to your significant other, how hard would it be to say, hey, by the way, we've just put $7,500 into a trade, and I now need you to come back with another $3,500 because we're going to dollar cost average. I need to come and go find another $3,500. Maybe if we did this on 3,000 shares, I need to come up with another 35 grand so I can buy some more shares, because the stock that I thought was going to 75 went down to 16. Oh, and I need to go buy some more shares at 16. I know you guys would look at me, or your significant other would look at you and go, well, let me get this straight. The stock you just bought up at 25 is trading at 16, and you want to throw good money at bad? What are you doing? We never have to go and ask our clientele to put more money in their account. Because we've insured their stock positions, their ETFs or indexes, whatever they happen to be in, we have the ability to dollar cost average through our insurance we have on the positions. What does this mean in real life? How does this make a difference? That same Pandora, same 100 shares, again, you could be at a $2,400 loss, down 32%. Well, because we've bought those more shares, picked up $200, still having a couple $100 left over, our break even is significantly lower. In fact, if Pandora just got up to $20 a share, we'd be at a 33% return. Let's say the stock gets back up to 25 where we bought it. This is the point where everyone that's now been in it for a year and a half, they bail out. They get out of Dodge. Was in Pandora, got out at a break even. Got out back at $25 where I bought it. Well, all the Hurley Investments clients, we're up 66% here if we choose to get out. Instead of having to wait for a year, maybe a year and a half just to break even, when it gets back up to where we were at, guess what? We're booking a profit. And of course, there are some of those that, hey, it got up to 29. I'm going to wait till it gets into 29. For everyone that bought at 25 and waited till it got back up to 29, you know what? They got out with, $4 a profit, about a 16.66% return. Whereas in insuring your portfolio, if we wait till it got back up to $29 a share, we've almost booked 100%. We're booking a 93% return on this position using the same money, the same starting point as everyone else, yet we're making money in these downturns in the stock market. Why is this so important? I've grabbed a quick screenshot here of the S&P 500. If you take a look at those numbers, you could go back to about 99 and have to wait all the way out to 2013 for that to get back up to break even. Now, some people tell me, well, this is the high side, Kevin. High side or not, if you got in way back there in pre-2000, you waited 13 years to break even. And now you start making the returns, which means for 13 years, you're hoping you don't have to retire. You're hoping you don't have to pull money out because you'd be pulling money out at a loss. 13 years. I don't know about you, but retirement doesn't wait on the stock market. It's really tough to try to outguess it. Well, Kevin, what if you bought in at a low? What if you got all the way in at 97? All right, so then you only waited 12 and a half years until you started to become profitable again. Guys, this is why the buy and hold doesn't work. In fact, I've even brought in a chart of the NASDAQ. If you're waiting on the NASDAQ, you've been waiting 15 years or more. There's got to be a better way to trade. There's got to be a better way for your money manager to care and protect your retirement. If you ask me, I would like to bring one other example on JCPenney. I kind of laughed because I had someone that wanted to get in JCPenney, just thought to myself, my goodness, you got to be kidding me. Kevin, go get me we'll start slow. Just go get me 300 shares again. Kind of interesting. We have a rule of 300 that we'll talk to you about later, but let's get me into 300 shares. Let's just put $4,350 at risk. Not a big amount. In fact, it's really pretty small. I talked to him and I said, we're more than willing to do that, but on one condition. I want to overprotect. We have earnings coming up. It's trading at $14.50. I'm going to buy you double the long put contracts, double the insurance contracts. Everything I read, all the metrics I worked out said JCPenney was going to go lower. Thank goodness we added some extra insurance to this position. Thank goodness I was right. It fell all the way down to darn near $6 a share. Now, I'd love to tell you we cashed in that insurance down at the bottom, but I can't pick the bottoms any better than anyone else. I have to wait till my technical crossovers. And at that certain point, when it was trading closer to $8 a share, we had long put insurance contracts that were worth $6.50. If you work out the math, having twice as many shares of insurance on the stock, we have $3,900, and we got to add 400 more shares of stock when JCPenney was trading at $8 a share. We added more shares of stock than we originally purchased without having to throw any extra money into the position, without me having to call them up and say, hey, I need another $4,000 to go ahead and get you some more shares of stock. Kind of interesting. It was supposed to go back up. Thank goodness we insured his positions again for the next earnings. We now had 700 shares. We bought 7 insurance contracts at $9 a share, and this sucker headed all the way down to $5. Again, I'd love to tell you I nailed it at $5. I did not. I wish I had. But the short answer is we made about $2 on that insurance contract. We collected $1,400 on the way down. At this point, I got to add another couple hundred shares. How is this in value as the stock continued to go up over the next 4 to 6 months? Well, we had 900 shares. And at this certain point in time, the stock was trading at $10 a share, a little bit above it. We were profitable $4,650 for 107% return on a stock that was down over 35% numerous times. At this particular point in time, it's down 27.5%. On a stock that literally has lost 27.5% from the day we bought in at it, we've got 3 times the amount of shares, and we still have the stock down 27.5% from when we originally bought in. Guys, I hope this is resonating with you on how important it is to start to protect yourself, to have the ability to maybe triple your shares of stock at 100% return over a 12-month period. It doesn't happen overnight, but if any of this is interesting to you, do me a favor, give us a quick call on our toll-free number at 888-287-1030. If you've gotten a hold of one of the registered investment advisor representatives that works for Hurley Investments, give them a quick call. If you'd like to follow along a little bit more, you can always go to the blog site at myhurleyinvestment.com. I've got a little blog window on the right-hand side. If you'd like some more information about what we do, send us a quick email to customer service at hurleyinvestments.com. I've got a Twitter handle at Kevin M. Hurley. Feel free to log on, follow us along. We send out trades, we send out tweets, we send out information about the market all the time. We try to do everything we can to give our clientele as much information about their retirement and what's going on in the stock market as they need. I appreciate your time today. I look forward to seeing you on some of my other podcasts that I'll have out there. Do give us a call at your earliest convenience, and I look forward to talking to you soon. Bye-bye.